Look, if you're trying to buy your first home in the Bay Area right now, I know you are dealing with a massive sticker shock. You're looking at the interest rate holding steady in the mid 6% range and the home prices sitting well over $1 million. And you're probably saying to yourself, how is anyone supposed to afford a starter home right now? I talk to buyers every single week who tell me they are just going to sit on the sideline and wait for the interest rate to crash back down to 3% or 4%. Honestly, sitting around waiting for that to happen is usually a costly trap. To understand why, we've got to look at what historic interest rate actually look like over the last 20 to 30 years ago, what the experts are predicting for the next few years, and what rating is actually costing you right here in the Bay Area and Silicon Valley. So think about it. If you look back over the last 2 or 3 decades ago, today's interest rates are actually pretty normal. Back in the 90s, interest rates hovered around 7% and 8%. Through the 2000s, leading up to the crash, they sat comfortably in the 6% to 8% range. Heck, if you're going back all the way to the early 1980s, the interest rate spiked to an all-time high of over 18%. So those 3% interest rates we saw during the pandemic, they were not normal. They were just a massive historic anomaly driven by the emergency government intervention. So expecting the interest rate to drop back down to 3% is kind of like expecting gas to go back down to $1 a gallon. It's just not happening. And major institutions like Fannie Mae, the Mortgage Bankers Association, and the National Association of Home Builders all agree on where things are heading. They are projecting the interest rate are going to hover stubbornly right in that 6% to 6.5% through the late 2026 and well into 2027. We might see a tiny gradual dip, but 6% is the new baseline. So what does that actually mean for you, for your wallet, if you're buying a home in the Bay Area? Let's look at the math on a realistic $1 million loans, which is super common. If you look at a comparative townhouses or single family home across the East Bay, the South Bay, or the Peninsula side. So if you bought at the recent peak when the interest rate hits 7%, your principal and interest payment is around $6,650 a month. At today's average, around 6.3%. That drops down to about $6,200 a month. And if we hit an optimistic future low of 5.5 down the road, that payment drops to about $5,600 a month. Yeah, waiting for that interest rate to drop from 6.3 to 5.5. Save you roughly $530 a month on $1 million loan. But here is the trap. While you're sitting on the sideline waiting for that interest rate drop, you are playing with fire in the Bay Area market. Inventory is still super tight, and demand from tech, AI, and local wealth is still high. If local home value appreciate by even a modest 4% to 5% a year, a 1.3 million home gains between 52,000 to 65,000 in equity in just 12 months. Plus the second interest rate dip even a little bit more. It's going to unleash a flood of sideline buyers who have been waiting just like you. That surge in competition leads right back to multiple offers and bidding wars. You might save a little bit on your interest rate, but you could easily end up paying 50,000 to 100,000 more just for the purchase price of the home. So before we dive into the stock market comparison and why renting might actually be costing you more, I'd like to ask you to take a quick second right now and hit that like button and subscribe to our channel so you won't miss out on the local real estate market in the San Francisco Bay Area.